Today, industry reaction to the RBA change. Hello again, it's Martin North from Digital Finance Analytics, one of this post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by John Falvell. Hi, John. How are you doing?
Hey, well, thank you, Martin. And you?
Yeah, great. And thanks very much for coming on. We were saying just before we started that our planet's been orbiting with the mortgage industry and stuff, but it's great to catch up with you. And look, this is a really important day. The RBA announced 50 basis points. You've been making some commentary on this. I'd like to get your immediate reaction. Was it in line with what you expected it was going to be?
The RBA has certainly been very effective in terms of broadcasting their intent over this most recent period. And by that, I mean the last 2-3 months as far as the direction of rates and also the increments and the velocity with which they're moving. So there wasn't, or very, very few people were surprised at all by this move, as opposed to the initial rate move that we saw, just in the lead up to an election there. I think that the market was caught on the hop a little bit and consumers were, and probably justifiably so, because the RBA or Philip Lowe himself had been saying that they didn't see any increases in the cash rate until 2024 or late 23. So the timing was a surprise, but the direction certainly wasn't, and the magnitude this time and the direction and the timing, none of those things were a surprise for the market this time. So we've been well conditioned over this last few months.
Yeah, so he certainly changed his tune because, as you say, late last year, there was no change until 2024. And then, of course, he explained it as, well, of course, things have changed. And I understand that. You can only make decisions based on what you know. But, of course, a lot of people would have made decisions based on no rate rises. How do you think this is going to play out? More rate rises ahead. Where do you think the terminal rate could get to?
Yeah, and I don't want to add to the conjecture in terms of where the rate might land. There's as many opinions on that as there are people in the market. But if you look at the intent and the stated intent of the RBA, they've made it pretty clear that their intention is to actually keep making adjustments to monetary policy until such time as they've got the underlying inflation rate in what they see to be a fair, reasonable target range of somewhere between 2 and 3%. And so everything in the statement today on monetary policy and the statement before that has said that the RBA will continue to make adjustments to monetary policy until such time as that target range of 2 to 3% is reached. Yeah.
But I guess the real consequence then is for mortgage holders, right? Because we've already seen fixed rates move up significantly, 4 or 5, in some cases even more than that. And variable rates will follow. That's going to put some pressure on some households, isn't it?
Yeah, it certainly is. And I think that, if you look at the way that the mortgage industry, the banking industry in Australia over the last 3, 4, 5 years in particular have set their sails as far as the provision of credit and mortgages to borrowers, then across the board, we've been pretty effective in building in a buffer. We've had interest rates at record, unprecedented low levels, a cash rate of 0.1%. Now, anybody that thought that was going to be long-term and sustainable, hope springs eternal, but it was never going to be the case. And so lenders and regulators alike have said, well, look, we need to look at the most likely landing point for the median mean cash rate over this next period. And accordingly, all lenders have put a buffer of something in the order of maybe 2.5% or 3% in terms of the rates that they're using to calculate borrower servicing. So we have quite a shock absorber built into the system in that, households can deal to these increases and still meet their ongoing costs of living in their day-to-day obligations. And if you have a look across the board, the proportion of home loans that are in advance of their minimum repayments, and then when they are in advance, the quantum by which they are in advance, there's a significant buffer there. And the vast proportion of people in the market have a buffer. But it's those people, obviously, that have maybe got into the market in the most recent times. They've got into the market at a point in time where asset prices were high and when interest rates were low. And so against this backdrop of increasing interest rates, then those or that group of people are the ones that are potentially at the greatest risk. And if nothing changes, if their income and their employment situation doesn't change and their living situation doesn't change, then there is a buffer built in there. But those are the people that are actually, I think, at the highest end of the risk curve in terms of these increments having an impact on them in terms of not being able to meet their ongoing obligations.
I think you make a very important point, because not all households are in the same boat, right? We know that there are many households that have got massive amounts of buffers and will be in no difficulty at all. But we also know that there are some other ones, particularly those who've taken the leap quite recently, maybe on the back of government incentives and, buy now, with potentially not a huge amount of real leeway, because, of course, the other thing that's changed is the inflationary costs of living, right? Yeah. And, the assumptions that people were making last year and the year before in terms of costs, it's going to be much higher now. So those people are going to be the ones probably, under some pressure. And there probably will be some other ones that will have to prioritise their spending a little bit and make sure that they can maintain their lifestyle as rates go up. Because, of course, when rates do move, the real impact on repayments is a lot higher than just the interest rate move, isn't it, in terms of percentages?
Yeah, sure. And I think you make a very valid point. It's about prioritisation. And, what history shows is that, and particularly I think in Australia, it's within the psyche of the Australian public, and is that, home ownership is the means by which you get ahead. Owning a home is almost sort of like it's almost a rite of passage for young Australians, and it's something that we've got very high instances of home ownership. And then what people do in terms of prioritising and going without to get their home in the first place is nothing short of incredible in some instances. And then the means or the ends to which people will go to retain their home are quite significant as well. And it is a case of reprioritising. Averages are dangerous things because they're made up of highs and lows. So I don't like to speak in averages. But if, we must for a moment, if you looked at an average Australian mortgage, say it was $450,000, and if you looked at the monthly servicing on that loan prior to this last 3 lots of increments in terms of the cash rate, then, on a $450,000 mortgage, you're probably paying something close to $300 a month more now than you were 3 months ago. And if the cash rate goes to 2.5% or thereabouts, as a lot of people are suggesting it will, then the difference for an average household will be something in the order of $600 a month. And for some people, excuse me, that's going to sound significant, but for others, it's going to be quite significant. And the question then comes down to what extent do people reprioritise discretionary spending and the sorts of things that they can do without in order to service their home loan. And of course, the RBA is well aware of that because, if your focus is in terms of economic management is about making sure that you've got a sensible target range for inflation, then if you're reducing people's ability for discretionary spending and you understand that the household portion of the household income that's going to debt servicing and paying the mortgage or rent, accommodation and so forth is going to increase, then your expectation is a diminished capacity for discretionary spending, and that puts less upward pressure on items, which diminishes the drive for inflation. And the RBA is certainly well aware of that. The question this time around, I think a very interesting thing is that when we look at inflation, what is it that's driving inflation? Is it consumer spending, on the demand side, or, is it more the supply side of things? And so what's led to increments in prices in, most recent months, I would say is not so much demand driven, it's more supply. And if you look at, what's happened, globally in terms of disruption to supply chains and what that's meant in terms of increases to the prices and the components of many things that we consume. If you look at the war in the Ukraine and if you look at the impact that that's having on fuel prices and the knock-on impact that has on everything we consume, and then if you look at food prices and the pressure that's been put on those by virtue of some of the flood events that we've had and continue to have, then all of those things all of those elements aren't being triggered by virtue of demand. Those are supply side inputs that have driven inflation. And, is monetary policy effective at dampening supply side inputs? No. Is it effective at dampening demand? Yes. But, it's sort of it's almost sort of treating the problem with the wrong piece of equipment, as it were. It's like trying to hammer in a nail with a rake. It's not very effective.
Well, I suppose if the only tool you've got is a hammer, then everything is going to be a nail, right? That's part of the problem. And you're dead right, because if some of those inflationary pressures are coming in from overseas, like the cost of oil, for example, listing interest rates is not directly going to impact that. It will crimp demand potentially, but that's a really blunt instrument, isn't it?
Yeah, it is. And it is, and in isolation, monetary policy is the mechanism the RBA has got in simple terms to use. And then the question is then what's the approach that the government takes? Are they working in concert with the RBA, or are they working at opposite ends? They're pulling in different directions. And so, what you have seen, obviously, is the end of the government bond buying program. So one's not pulling against the other, which makes sense. And then the question comes down to, okay, are there other things that can be done in terms of taking pressure off consumers? So, removing the excise on fuel. You look at increases in sort of household expenditure, and to fill a motor car, may have cost you 3 months ago something in the order of $100. It's costing you $150 or $60 a month now. And guess what? In a post-COVID world, we seem to be using our motor cars again. So the increment to the household sort of expenditure just on fuel alone it's enormous. And in most instances, it's more than the sum of all of the increases in the cash rate that we've had in recent times. That's not driven by monetary policy. That's driven by what's happening overseas in terms of, war in the Ukraine and supply chain disruptions. And so, Philip Lowe and the RBA board members are incredibly competent, capable, intelligent people, and they've got to take a broad view, and they do, and they've got to work in concert with the government to get effective outcomes. And you'd like to think that, despite what your opinion might be in the level of effectiveness of various political leaders and so forth, and whether it's the RBA, or whether it's the government, or whether the truth lies somewhere in the middle, then typically Australia's been pretty effective over both sides of politics and many years of political cycles. Australia's been pretty effective, or highly effective, I would say, in terms of having a good relationship between the government and the RBA in navigating a sensible path through some very dicey times that we've had over this last decade, 2 decades, and even going back further. So you'd like to think that common sense will prevail and cooperation will prevail, and we'll get through this somewhat uncertain and lumpy time.
Yeah, well, certainly there's a few things around, but I wanted to come back to borrowing power, because one of the things that with Wave Money and what you're doing, you're in the middle now of the mortgage industry, and perhaps trying to recraft it and think about it a bit differently. But what I'm interested is, with interest rates going up, the amount that people will be able to borrow on a set level of income is now lower, isn't it? And it presumably will continue to be lower as rates go up. And I guess 2 questions: what is that doing to borrowing power? And then secondly, what do you think that may do to home prices?
Yeah, sure. And certainly as the cost of money goes up, then a prudent approach from a lender's perspective is to adjust the amount of money that you make available to would-be borrowers, and it's about their capacity to service the debt. And certainly, as I said, for an average mortgage, $450, the cost of that mortgage may be $450,000 rather than the cost of that's gone up by $300 a month. And, that may mean that on average, then a household's ability to borrow has probably been trimmed by something in the order of maybe, $120,000, which is a not insignificant amount of money. So, and look, not everybody is at that pointy end. Some people have more capacity than they use. But for people that are right at the edges of their capacity, then maybe their capacity to borrow has come off by 10 or 15%. And that impacts different parts of the market. And, there's the supply, there's the demand, and then there's the capacity to pay. And capacity to pay is driven by access to funding. And so that has had an impact. And, all of those things together will drive asset prices. And if you look at, where asset prices or real estate prices might be now, I think that, we saw the median house price in Australia, I think it was in January of this year, across the nation went north of $1 million for the first time, which in itself is possibly not so spectacular, but the actual rate or the velocity that the median house price increased by over the 12-month period was quite startling. It was something in the order of 29%. I think most people would expect that when things go up rapidly like that, then there's more potential for them to correct as well. And so what you'd like to see in this cycle is that, in the RBA, as I said, competent, capable, intelligent people that take a holistic view, what you'd like to see is that the RBA is very much well aware of this, and the very worst thing that they could do is bring about the very thing that they're endeavouring to avoid, which is a collapse in asset prices. So it's, gently she goes. The problem is, as we've said, monetary policy is a relatively blunt tool. And if it's the only tool that you've got, then you've got to do what you can do. But typically in these sorts of cycles, what happens is the pendulum gets out of whack, and maybe with cheap funding, then the asset prices of real estate swings to one extreme. You adjust the cost of money in order to bring inflation into check. The ability to actually access increased pools of funds to borrow diminishes, and asset prices come off. And so it's a balance of saying, well, how much is enough to slow things down potentially, and how much is too much that actually puts things into a precipitous sort of a fall sort of a situation. And getting that balance right is probably art and science, but typically the pendulum goes beyond centre before it comes back, and these things are not precise, and sometimes you make an action and you get an overreaction. It's finesse is required.
And particularly, of course, because the property market is not one market, is it? It's multiple markets in multiple geographies with significantly different dynamics. If you look at Sydney and Melbourne and compare it with Perth or Brisbane or Adelaide, Tasmania, I mean, these are very different markets, aren't they, with very different dynamics?
And even within those, those capital cities themselves, there's many markets within markets. The inner suburbs, the outer suburbs, the nature of the housing, as apartments or freestanding homes. And, there are things beyond, obviously, the cost of money that drive those markets too. It's access to employment, access to utility, education, all of those sorts of things, drive those markets in different ways. And when supply comes on hard and fast in certain areas, then that can have impacts as well. So markets within markets. And as we said, dangerous thing is to talk about averages, but you've got to kind of keep an eye on the averages, as it were, in order to sort of, do the best you can across the system.
Absolutely. Well, let me just come back to Wave Money, because this is a rather interesting venture that you're leading. You're the founder of this. So what's the vision of Wave Money, and what differentiates it?
Yeah. So with Wave Money, Martin, you and I have been in the mortgage industry for many years, and what we saw at Wave Money, that increasingly there was a group of consumers whose needs were just not being met by many banks and many non-banks in terms of giving them access to credit to purchase a property, to purchase an investment property. And what we saw is that banks and many non-banks, the way that they approach credit has not kept pace with the way that people's employment and the nature of employment that they're undertaking has changed. So, if you look at a couple of groups of people, we've got 17% of the Australian population that are the Australian workforce that are self-employed. And, they are also, that self-employed group of small business owners is also the single largest employer and creator of new jobs. But if you look at the approach that the ADIs and many non-banks take to assessing them, then a lot of the nuance and the understanding and I think, the ups and downs that businesses go through just doesn't factor into those decision-making processes. So, with Wave, it's about saying, well, we understand there's a significant part of the market there. These people are vital to the economy. They are creating jobs. They're growing the economy, but we need to work with them more closely and not take a cookie cutter approach in terms of assessing their ability to service a mortgage. We want to make sure that they can service their mortgage and meet all of their obligations. The last thing we want to do is help anybody to heartache, but you need to take time and you need to understand the individuals and their businesses and their situations. And so that's a big part of what we do, and it's the largest part of this lending solutions that we provide. And our belief also is that those people's needs are best served by mortgage brokers. Mortgage brokers have the opportunity to go out and work across the market and work with many lenders, and they can understand what is genuinely in the best interests of their consumers and where to get those needs met. So Wave Money exists exclusively to serve consumers whose needs may not be met by banks and non-banks, and we exist and work exclusively through mortgage brokers to get those consumers' needs met. Beyond that, then there are a large group of consumers who may be traditional PAYG wage earners, but what's traditional and what's probably traditional now are two different things, and particularly, the nature of the work that the people are doing and how it's structured has changed markedly as well. And you talk about the gig economy, you talk about people working from home, working on contract, working part-time roles, multiple roles, and so forth. It's fundamentally changed, and certainly COVID's accelerated that change. And many lending institutions just haven't kept up with that and don't understand that. And constantly we're finding people frustrated by saying, I work in the industry, I work in media, I work in production, I work in something such as that, but I have, one permanent contract, one part-time job, and then I also do something under my own steam. But many lenders just don't understand that or won't take that into consideration. And more people are working like that. And so basically our proposition is, once again, it's about seeking to understand people's situations and find solutions for them without taking a simplistic cookie cutter approach and using mortgage brokers to assist those people in terms of getting a solution through Wave Money.
So that presumably means a little bit more time spent with them, a little bit more analysis of their own situation, rather than, as you say, the cookie cutter, which is if you fit this size, you get in. If you fit that size, you don't get in, which is a bit black and white. So you're playing with the grey there and trying to find the right solution for the right customer. And I think the SME sector in particular, certainly, I think is getting hard done by across the the industry from my survey. So I think there's an interesting
absolutely. Yeah. And you talk about grey, and then there's what's black and white. And I tell you, the definition of what's black and white says me in the black and white outfit. But the definition of what's black and white is very, 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 very restrictive, and it's very, very narrow. And so what would have been considered black and white, 2, 3, 5 years ago, and very, very simple, is now considered grey. And those people then, they don't represent any more risk than they ever did. They're good people. They're running, vibrant businesses or getting out there and working hard, and they deserve the opportunity to get access to the market through the provision of credit. And that's where Wave Money exists to serve their needs. And people say, what's the Wave and the Wave Money all about? That's actually just looking about those parts of the market that get dislocated, or those consumers that get dislocated or have their access to credit taken away as you get regulatory shifts or attitudinal shifts. You get shifts in curves in terms of rational risk return curves, and that's the Wave and Wave Money. And we only see an increasing number of people who are challenged by the very restrictive black and white type approach that lenders take in terms of the provision of mortgages.
No, actually, well, I'm a great supporter of anything that makes it easier for those SMEs, because I think they're really doing it tough at the moment. Yeah. And many of them are actually very viable. They've got very great businesses, but unfortunately, they don't fit the standard approach, and therefore they get stuck. So all power to elbow there. John, I really enjoyed speaking with you. Thank you very much, and fascinating to get your perspective on what's happened today and what's going to happen. And maybe we can come back to another conversation a bit further down the track in more detail about precisely how this interfaces with the SMEs, and because there's a really big conversation to have there, I think, in terms of how we facilitate and help that sector of the market in particular, and other people, as you say, in the gig economy, who again fall outside the standard norm. So thank you for your time.
That's my most sincere pleasure, Martin, and thank you very much indeed, and would love the opportunity to come back and have that chat.
Great, thanks. Take care.
Thank you.